Good morning, everyone. My name's Arthur Manners. I'm the Finance Director of Helios Underwriting PLC. I've been working in the insurance industry for over 30 years, so we've been hopefully a little bit of experience. And I've been working here since 2016. And I would like to explain to you why I think Helios Underwriting has got to a position where it's a story of jam today rather than jam tomorrow. I think for the last 2 years talking to investors, I have been trying to say it's going to get good, I promise you. I think I should have bought a pot of jam in with me from home this morning and be showing you that the jam is ready and waiting and is on the table. I think that's the message that I want to get across to you. So if I can turn to page 3, please. What is Helios? Helios is in fact a sort of an investment company, but we're not structured as an investment company. We're obviously listed on AIM, sort of a small cap company. And what we do is we select management teams within the Lloyd's insurance market. So we have the skills to invest or select the better management teams and deploy capital within the Lloyd's insurance market. So we provide investors exposure to insurance and reinsurance risks. That is a pure exposure from which you will get, which we get profits from deploying the capital, which then is returned to shareholders by the way of growth in net asset value and dividends. Our skill in selecting the management teams and deploying capital is providing investors a diversified and curated portfolio of the better performing syndicates at Lloyd's. As the syndicates are the people who are the businesses, and there are substantial businesses in there that underwrite the risk, each individual risk. We're not taking the decisions on what risk to underwrite. We let the management teams, the syndicates, do that on our behalf. Hence, we view ourselves as an investment company. We merely select the management teams to make their own decisions of which classes to underwrite, and then we build a portfolio to ensure that we are not over risks in a particular area, and we have a balanced risk managed portfolio as a result. The insurance returns are uncorrelated to the equity markets. The insurance market is a cyclical market, and the prices for insurance, as you've probably seen from your house insurance, your homeowners premiums, have been going up year on year. Insurance premiums for all classes of business have been going up for the last 5 years. We've probably reached the top of that. For investors, that is good news because we are now in a part of the cycle where the prospect of underwriting returns and underwriting profits is much better. So the management team at Helios is led by Martin Reith. He joined in April of last year. Martin's background is as an underwriter at Syndicates. He has built and managed significant businesses, syndicate underwriting businesses at Lloyd's. His experience and knowledge of the insurance market and the people who work in it is fundamental to our ability to select the better performing syndicates. Martin has, he took over from Nigel Hamry, as I say, a year ago, and I think his ideas and vision to grow the company is quite exciting, and I think will move Helios on to the next stage. So the market opportunity is quite key. As I said, the insurance cycle has been hardening. The rates are much better. And secondly, more importantly, the investment returns on the underlying assets that are managed by Syndicates and by Helios are significantly better than they were 18 months ago. And we all know that as interest rates have risen. So those are two tailwinds, which I think are going to significantly enhance shareholder returns in the future. Quick bit on financial performance. We manage a capacity portfolio, and capacity is the denominator showing our share of each of the premiums written of about £500 million. And that's grown significantly over the last few years as we've managed to take advantage of these better market conditions. The net tangible asset per share as at the 3rd of September was 176p per share. That's the key metric by which we measure shareholder growth. So at the half year it's 154. It's risen to 176. We're going to be making an announcement shortly of our estimated result as at December. Haven't quite got the numbers in, but that'll be next week or the week after. We have a dividend policy of a base dividend of 6p per share, which will be supplemented by special dividends as and when the cash within the business and the prospects allow for it. And we'll be making announcements on our dividends and our year-end results in the end of May of this year. We issued 75 million of debt to US investors last December, and that has allowed us to build a cash and capital buffer, which I think is quite important, which is going to allow us to fund the future growth of the Helios retained capacity. Very simply, for every pound of capacity that we add to the portfolio, Helios has to provide another 40p of capital to be lodged at Lloyd's. So that's $75 million is going to allow us to grow the portfolio into 2024 to get to the 500 million and from 24 into 25. And I think that will help us continue the rate of growth that we've achieved over the last few years. Next slide, please. These are a few metrics on our portfolio. What I'm going to talk about is one is the portfolio of syndicates that we deploy capital to, we invest in. And secondly, later on, I'm going to talk about the capital management and the finances. So that's the two sides of the business. We select the syndicates and the businesses where we deploy capital, and then we have grown the number of syndicates which we support. We currently support 43 syndicates, and that's grown from 28 in 2022. But the key driver to value for Helios shareholders is the bar chart in the middle, which is showing the growth in the capacity from 245 to 502. But more importantly, the bottom element of the box, the retained capacity, has grown from 182 to 378 million. Now, 378 is the current share, Helios shareholders' share of the overall portfolio. It is the retained capacity which will drive earnings in the future. And the retained capacity in 2022 is currently driving the earnings in calendar year 23 and in 24. The delay in recognition of profits is a key part of the investment criteria of business. So we can see the growth in the retained capacity, we can see the better market conditions, and we can see, therefore, the pipeline profits that are coming through. I'll come on to more of that later. So our 2024 capacity portfolio, the syndicates in aggregate have forecasted, our share of the syndicates, a combined ratio of 89%. A combined ratio is a measure which is widely used in the insurance industry, and very simply, if it's below 100%, you're making money. And at 89, that forecast, it's making sort of 11 points of profit on every premium pound, which is going to hopefully generate quite a lot of profits based on the retained capacity. Within the portfolio, we have, of the syndicates we support, we have permanent rights to remain on those syndicates. That's rights, permanent rights of tenure. Those rights of tenure are tradable. There's an annual auction process, and we can attribute that annual auction process gives us a market value of those rights to participate on the syndicate. And we have rights to participate on the likes of Beazley and Hiscox and other well-known insurance names. That value, as at the end of December, was about 82 million, reference around 78p per share. So it's a core part of our asset value. It is an intangible asset, and so there's always a bit of a, but it is a tradable intangible asset. We do buy and we can sell that capacity. So we could sell 10, 20% of that portfolio very easily in the future and turn that value back into cash for either to deploy for underwriting or to return capital to shareholders. And that's part of the difficulty in the valuation of Helios, because you look at that intangible asset and say, is it a real asset? I would argue it is quite a real asset because we are able to buy and sell that capacity, and there are buyers for it. The diversification of the portfolio is key. So whether we support, as they say, 43 syndicates, the capital that we had to lodge at Lloyd's regulate the market, thus our regulator, is 40p in every pound of capacity, which gives us a significant gearing advantage to the extent that if we were supporting a single syndicate, that ratio would be significantly higher. Because we support a broad range of syndicates, very simply, they're not all expected to go wrong at the same time, and therefore we can lodge a smaller amount of capital because the expected loss is going to be lower. Just to be clear, we are investing in a risk business. I think insurance is risk. The purpose of insurance is to transfer risk. You pay your premium, you get your claim paid, but then in the future, over the next 5 years, you will probably pay a slightly higher premium back to the insurers to repay the insurers to some degree, hence the insurance cycle. So the syndicates model their larger expected losses. 20% of our portfolio is exposed to natural catastrophe risk, which is hurricanes, flooding, and earthquakes around the world, and last year there were significant amounts of those. Actually, but not much of it came back to Lloyd's as insurance losses. But the syndicates estimate that a large series of losses would contribute about a 17% loss on capacity. So it's a large, it's not it says largest, it really shouldn't say it is not the largest, because of all the underlying exposures. The loss could be larger, but that's their expectation of what a likely large loss is going to be, and we manage the portfolio to that metric. Turn the page, please. Few more stats on the portfolio and the diversification of the portfolio. In terms of, I've touched on this freehold capacity in the valuation, which represents 35% of the portfolio. In terms of the range of forecast profitability from the syndicates, 48% of the syndicates forecast a profitability in the low 90s, 36% forecast profitability in below 90%, and a few do better than that. So they are all individual businesses, they're all separately managed. Each management team makes their own decisions on what business to underwrite and where they think there is the best prospect for underwriting profitability. And I think that's sort of key, is we are then to, again, as I said, we select the management teams and the syndicates where we're trying to build this diversified portfolio. We make sure that we don't go overboard on any particular syndicate. So our largest syndicate capacity is just over 30 million, which is 7% of the overall portfolio. Some of the syndicates that we support are new startups. They're not new to the insurance industry, but they're new to Lloyd's, and those management teams that are trying to create a new business, we're very keen to support those teams. They have to have a track record of profitable underwriting before we will support them, and they'll either do that because they've been underwriting through another business, and they want to use the Lloyd's infrastructure to build a business. So in terms of the type of the established syndicates represent nearly 70% of the portfolio. Another part of the diversification is the classes of risk. And between short tail, by short tail, you know the claims have happened. It's a fire, it's a flooding or something like that. It takes a bit of time to work out the loss, but you know it's happened. And there are some classes of business where it takes 3, 4, 5 years to work out the eventual loss on a claim because there's litigation involved, because it goes to court or wherever it is. And that, so 60% of the portfolio, we know pretty early on whether it's going to be profitable, and 40% portfolio, it just takes us slightly longer to establish the profitability, and the reserving, the money set aside by the syndicates to cover those longer tail claims is key to establish the profitability. Cyber insurance, which is always an interesting one, everyone worries about whether that really is insurance. It represents 10% of our overall portfolio. It is making money at the moment. Yes, there are lots of question marks over whether it is a long-term profitable class of business, given the nature of the ransomware attacks and who perpetrates those. But there are a lot of underwriters and very bright people trying to work out how to price that risk and what persuading the companies that are insured to put in the correct protections to mitigate the risk of cyber losses. We think that it is a class of business that will continue to make money in the future. Next page, please. This is my Persian carpet slide. It quite looks like a Persian carpet. It's a visual picture of a diverse portfolio. Each of the names here on each of the boxes is a separate business, separate management team. Top left is Beazley. So Beazley, that 32 million, that's our largest participation on the single syndicate. If you saw the announcement of the Beazley results this morning, where they declared pretty stellar results, we participate pari passu with those results. So Beazley have declared good results. That top left-hand box will declare good results as well. And Beazley and those results, I think, are a clear indicator that the jam has arrived, that the profits are now being recognised within the insurance industry. And I fully expect that to our results to not to be quite as good as Beazley, because I think that'd be quite difficult, actually. I think it's a stellar set of results, but our results will follow in that trend. Let's turn on to the market conditions. And this shows the chart. The Lloyd risk-adjusted rate change shows the increase in the premiums received, risk-adjusted for all terms and conditions. So very simply, in 2017, if you were receiving £1 of premium for all the risks that you underwrite, today you're receiving £1.50. Obviously, there's claims inflation within that, and it's not straight to the bottom line. Insurance is a simple business. It's premium, less claims, less expenses equals profits. But if the premiums are increased by 50%, there is a better chance that you are going to make underwriting profits in the future. Now, this rate change chart, this is up to half year 2023. That rate change chart increased to get a bit more in the second half of 2023, and I think will then tail off. But if in the next 2 or 3 years, we're still going to be receiving 50p more than we were in 2017, and we were struggling to make money in 2017. So these better market conditions are going to continue for the next few years. And this is reflected, these better market conditions is reflected in the combined ratio. So you can see in 2017, it was 114%. Lloyd's lost money. And we mirror the Lloyd's market pretty closely. So the combined ratio has come down from 114 to 85. I think Lloyd's are going to announce its results today or tomorrow. We'll see what their full year results, but it's going to be in the low 80s. It's going to, the overall Lloyd's market, that is a proxy to the Helios results as well. I'll come on to a bit more on that in the future. Next slide, please. So what have Helios been doing to take advantage of these improved market conditions? So the left-hand chart shows the rise in capital employed. The capital employed has increased because we raised money in 2020 and 2021. In 2020, Polar Capital joined the shareholder register as a 12% shareholder and has been very supportive since then. In 2021, two more significant shareholders, Resolute Group and Hudson, joined the shareholder. We've raised about 70 to 80 million pounds from shareholders. They were prepared to invest in the business 3 years ago because they saw the opportunity of the improved market conditions. They have had to wait for the jam to arrive. Today, as I say, the profits are coming through. They are going to benefit from the improved profitability of the business, but their capital has allowed us to grow the business over the last few years, and that is that the pipeline of profits has been growing. So that growth in the capital employed and new money from shareholders, we have grown the orange boxes, the orange and blue boxes within the business. So the 172 in 2022, which is the retained capacity, the 245 in 2023, that's the retained capacity which is going to grow the earnings of Helios. The blue boxes from 2018 to 2021 was where we bought small existing businesses or investment companies that participated in Lloyd's. That's the private capital world in Lloyd's. Individual investors own limited liability vehicles in Lloyd's, and we have been buying them up because they participate on syndicates, which we like, and we pay cash for them, we buy their companies. That has been, in the past, a way of building value, and we've achieved reasonable profitability from buying those. Today, we're not buying those companies. The prices for those vehicles have gone up because there's greater demand from other purchasers. So we've stepped back from that market. I'm sure we will re-enter that market at some stage in the future. We turn the slide. Thank you. This is an indication of how our retained capacity has grown by underwriting year from 21, 22, 23, and the improvement in the year of account forecast from 7.2 to 10.9. So the improved forecast and the higher retained capacity will generate earnings in the future. So of that, the 2021, some of that has been recognised today. 2022, actually in that first calendar year, there was a loss recognised of 4 million. So actually there's about 17 million to be recognised in 2023 and 2024. 2023, we'll see how much is recognised, but that will come through. So there is a bow wave of profits that will start to flow through. And the table below shows the reconciliation of the net assets per share as at December at 151, growing to 176 at the 30th September, showing the capacity revaluation and the profits per share as at 30th September. The track record of Helios Underwriting as a portfolio manager. So we have outperformed Lloyd's, the performance of all Lloyd's syndicates by an average of 7.9%. And that outperformance is based on a return on capital. I said earlier that our capital requirements, the capital we have to deploy, is lower than Lloyd's as a whole. We have an unfair advantage from the diversification. Not only, so our outperformance has come from our better gearing, and also because we have been better at selecting the more profitable syndicates. Or when you're doing in any game portfolio management, you have avoided the docks, and we did avoid the poorer performing syndicates during this period. More recently, I think it's going to get more difficult to show significant outperformance, because it's not often you hear anyone saying the regulators have been doing a good job, but the regulators at Lloyd's have been, and they have the Performance Management Directive have ensured that underperforming syndicates and underperforming underwriters, class underwriters, have either stopped underwriting or they have remediated their business that they underwrite. So they have been, and that will improve the performance of the Lloyd's market as a whole, will improve the Helios overall returns, but it might dampen our outperformance in the future. So quick summary, last slide, then we can get on to questions. Helios is an investment company that gives access to insurance and reinsurance exposures through the better performing and high quality Lloyd's syndicates. Our job is to select the better performing syndicates and offer investors a curated, well risk managed portfolio to invest. We have a track record of generating better returns than the Lloyd's market as a whole. The market conditions are in our favour, and particularly with interest rates where they are. We have access to the better syndicates, and we will retain that access rights to we will be able to remain on those syndicates for the long term. We now have an opportunity to return capital to shareholders through share buybacks and through dividends, and we'd expect the dividend, we will be declaring a 6p dividend in May of this year, potentially supplemented by special dividends. And we have finally a sort of a well and efficient capital model, which allows good built-in capital leverage for shareholders. I hope that made some sense. If there are any questions. Yes, of course there are a few questions. Good, I'm delighted. They have all. Let's see, and if anyone wants to ask any questions, then do just use that Q&A tab down the bottom to do so. Gerald, well, I shouldn't use people's names actually, but we've got the first one is there's a very small free float around 6%. I don't know if that is accurate or not. I'm assuming it is. Are you hoping or planning to increase this? That's a good question. There is a small free float, yes. The significant shareholders I talked about, plus, and the directors all have significant shareholdings as well. So we are clearly aligned with shareholders. We are a micro cap stock on the AIM market. We have great difficulty in attracting significant institutional investors because of the lack of liquidity within the shares. And that's sort of where we are because of the size of the business. Notwithstanding that, we perfectly recognise that there is a small number of shares that trade within the market. There is one shareholder at the moment who has been selling shares, that's Hudson Structured, and hence we've been doing the share buyback. We've been doing the share buyback to manage the downside on the share price. So if there are shares available at the moment, not because Hudson, we believe, will continue to want to release some of their shares. So actually, I think it is a good time to buy some shares at the current levels. If and when the selling pressure from the Hudson the Hudson shareholding ceases, because they stop selling their shares, then I think the share price should advance, because very simply within share prices, if there are more buyers than sellers, the share price goes up. And we're obviously trying to encourage more buyers.
And I suppose that begs the question, is the share buyback program would it continue beyond Hudson selling? Is it something that you see as a relatively permanent feature whilst the share price is at this level, and presumably you have the liquidity to manage that?
We would, if at this level, where the share price is sort of the 130 something, isn't it, 135, versus the net tangible asset of 170, it's within shareholders' interests to buy back the shares. It's a small click on the dial. Just to, every time you buy back a few shares at that discount, it's a good use of money. It doesn't really turn the dial, but it's incremental value creation. If the share price moves closer or above net asset value, then that buyback will cease, because it's not within shareholders' interests.
No. And I suppose the other part of that equation is the value that you see in the market at the moment, in the Lloyd's market, where the returns that you anticipate making from investments that are made today compared to the immediate uplift you get between the share price and NAV. So I guess both of those factors.
Well, I would like to say that I see the attraction to Helios and investing in the insurance world as being, it should be an income producing stock as well as growth in asset value. I'm trying to explain, this business will throw quite a lot of profits off and quite a lot of cash. The growth in the business will flatten out, because that's what happens in the market conditions, and therefore we'll be able to return capital to shareholders by way of dividends and special dividends. Investing in insurance has always been the matter of using assets twice and generating a further income stream. And nothing has changed. It's a way of deploying your capital and generating an additional income stream from that capital.
And so I'm drifting away from the questions and answers, but I always like to use these sessions to learn something myself. Presumably, from what you say, if it's an income producing asset primarily, to what degree are the valuations dependent on inflation expectations?
It's a good question. So the inflation expectations within the underlying insurance businesses are now carefully priced in. So each class of business, they assess what the inflation expectations are, whether it's building materials or litigation costs, we call that euphemism of social inflation. That is priced in to the premium that they are expecting to pay. That's one aspect of inflation. The other aspect of inflation is the investment yield. If inflation drops back to 1%, 2%, and yields come back down again, well, then we'll earn less money on our investments. My view is I think we're at a sort of 4 or 5% investment yields for a number of years, particularly in the UK. I don't see that coming down. Then the other, in terms of the investors' inflation assumptions, if they want to achieve returns greater than inflation from their investment, therefore the yield has to be greater than the 3-4%. I would suggest that a business which is paying base dividends and plus special dividends will achieve that incremental yield above inflation over the next few years. Not forever. We are a cyclical business. We are a risk business, but the tail of the market cycle is 5 years plus.
Okay, very helpful. Well, we'll go back to the questions now. Roughly, how many syndicates exist?
About 70 in all.
And how many do you realistically hope to participate in over the next year or so?
I think we're probably capped out at sort of 40. So within our curation of the portfolio, some will join, some will leave. Some will leave naturally because they find other capital providers. Some will leave because we come off those syndicates, and we as with any portfolio manager, you make a decision to part ways with management teams, either because you don't think they're doing very well, or because the business they write doesn't fit within the portfolio curation which you're trying to achieve. Basically, they don't fit into the pack of cards you're trying to build. So will it increase? Yes, it will a bit, but I don't think it's going to turn. It won't be the 70. We won't participate in every syndicate because the remaining syndicates are wholly funded by US and overseas insurance companies, and we can't get access to those businesses.
Okay. Is the $75 million of debt a long-term feature or something that you're looking to reduce over time?
It's a 7-year term. There's an interest coupon of 9.5%, and we're earning 4 to 5% on that money in short-term dollars at the moment. So the net cost is around 4 to 5%. So I'm very comfortable with the net cost of the debt. We can start repaying it after 4 years. We have to repay it in 7.
Okay. And when you repay it, you presumably at that point take a view. But I imagine some degree of structural gearing is probably something that is optimum for your company over.
Yeah, gearing is optimal to Helios shareholders because it creates better bang for the buck, I think.
Yeah, exactly. I don't know. I always caveat things. You might not be able to answer some of these questions, but are you able to comment on OD Asset Management stake? Because obviously there's been a lot of gossip about them.
Yeah, sure. So the OD Asset Management, you've always got to choose your shareholders carefully. We didn't do particularly well with OD, but there we go. But they sold. He bought about 5 million shares in December. 2022. I think about 1 million of those shares have been sold, and the remaining has been split between 3 different businesses that have evolved out of the OD Asset Management Group. And we believe they're all long-term holders.
Very good. I think it was this week you announced a new COO, and
Yes.
been asked to just say a few words about that.
Yeah, absolutely. I think we need to. Martin Reed is going to be taking the business onto the next stage. Nigel Hanbury and I had a lot of fun building the business up to the 300 million with sort of a limited resources, should we say. So I think if you're going to take it up to the 500 million and beyond, then I think we need to build the resources in the business, not only as part of succession planning. I am at the young age of sort of mid-60s, and Martin is, I think, 60 next year. You need to build in the next level of management who will understand and be able to grow the business. Absolutely the right thing to do.
Very good. How is your risk? How much of your risk is reinsured? And sorry, I will just press on because I think this chap's question sort of came in almost in two parts. Do you have any investment in reinsurers?
So I think somewhere on the slide we say that 20% of the portfolio is reinsurance. So of the underlying exposures within these syndicates, 20% of the risks underwritten is reinsurance, and that can be property reinsurance as well as mostly property reinsurance and longer-term reinsurance. The decisions of the reinsurance that they insure and the reinsurance that each syndicate has to protect their portfolio is each management team's responsibility. We have no input in terms of the protections that the syndicates put in place to protect the capital providers, Helios being one of the capital providers. Helios does buy reinsurance to protect the portfolio, and we provide a stop loss, if that's a sort of, so that if the overall portfolio loss is in excess of 7.5% of capacity for one year, we get a quasi-equity injection when if the loss is greater than 7.5%. That is our sort of downside protection, which provides us extra cash as well as part of the stop loss policy.
Okay. You mentioned that your results will be roughly pari passu with Beazley's this morning.
Well, I didn't quite say that, Paul, but there we go. I love it, but I don't think it's going to be quite okay. They had a combined ratio of 74% or something. We won't quite get to that. No. No,
I can confirm that. My ears were yes. I'll be your witness for that. So I'll caveat that. That's what the question says. But yes, you said that they'd be good, but not as good as Beazley's, I think, or words to that effect. I believe Helios only participates in the Beazley Syndicate rather than the PLC results in total, which include other business from UA and Europe as well as their PLC asset returns. Is that correct?
That's correct. Yes, it is. Yes.
Okay. That's fine.
It is. Yes, absolutely right. There are lots of other businesses within Beazley which we don't participate in, but the core London market business, yes, we do participate in.
And the $1 million question, I think we were talking about this before the webinar went live, is why currently is there such a disconnect between the share price and NAV? And he mentions Hiscox, which you're not comparing like with like, but their share price stays about 1.6 times its NAV by comparison.
I think that comparison isn't quite right. We would be very happy as an investment company if our shares traded at net asset value. We shouldn't be trading significantly ahead of that. We shouldn't be valued at the 1.4, 1.6 times of Beazley on Hiscox, because this element of the capacity value, which I'd say is about 80 million or 60 odd p within the balance sheet, is the equivalent of the premium over net assets of a market value. And it is always I think it is correct to say that the capacity value is the value to participate on a syndicate, and the premium of market value over net assets on Beazley and Hiscox, the 0.6 or the 0.4 times, is analogous, not quite the same, but it's analogous to our capacity value on the balance sheet.
Yeah, ultimately, though, as we were discussing earlier, it's supply and demand, particularly in the small cap sector of the UK at the moment. And I think we all can see that there's huge long-term value. There's a lot of things underpriced in all manner of all corners of the market. Just a question of when we get fair value back and when the market starts working properly again. The attraction of the UK market to investors is a cyclical one. If and when America stops generating quite such significant, fantastic returns for shareholders, they might come back to the UK and start looking. There is value in the UK. There's value in smaller cap stocks. If Helios is eligible for inheritance tax, being an AIM-listed company and participating in Lloyd's. If that's of interest, stick a few of the Helios shares into your portfolio and your heirs and successors can benefit from it. Very good. And I think we're more or less up to the final one, because I did roll the last one into another question earlier, which is why has there not been more new players coming into the market, given the very firm conditions over the last couple of years, or have there been and they've just not been listed?
That's a very good question as to why haven't the big private equity houses started new insurers and reinsurers as they did in 2001. There isn't a new class of big private equity money flooding into the insurance market at the moment. That is good news for existing investors, because there isn't a new wave of capital which will need to write business at lower prices, which will drive the market cycle downwards. Why haven't the private equity world joined the game again? Well, that's a question to the world. I think they're in a bit of a mess, aren't they? They've got their own problems to sort out as a result of the rising interest rates. So they are, at the moment, not playing. It's good news for the existing players, I can assure you. It is not a negative sentiment.
Well, yeah, the less competition there is, the better for pricing, presumably, etc.
Absolutely right.
And I think the last question, I'm not sure this can be quite right, but you'll correct me. Current Helios SP about 0.8% of NAV, which I think must be wrong. Otherwise, I'm putting all my money in right away. Is this disappointing? Presumably just about the discount to NAV in general.
Of course it's disappointing, yes. But I think it is, coming back to this, my pot of jam, and me telling the story of jam tomorrow. And if you look back at our December 2022 results, which was sort of because of the poor investment returns, that masked better underwriting results, better investment returns, improved profitability in 2023. We are now going out on the front foot saying the jam is here. we are delivering profits, we are going to be delivering value to shareholders. So it's been a different story that the Helios management team have been broadcasting over the last few years to what we're going to be able to do over the next few years. I think that's quite exciting.
Excellent. Well, I think that answers all of the questions, and I think it gets us through to about 12 o'clock. So that's perfect timing. So I don't think there's much more for me to do than to thank you very much, Arthur, for a very informative and interesting presentation.